to our inaugural WealthMed QSuper live broadcast. We are so thrilled to be able to bring you exclusive access to Andrew and Fred today, and I'll fill you in a little bit on them shortly. I'm Jo Tinetti, a Senior Financial Advisor at WealthMed. At our firm, we help medical professionals turn their successful careers into rich lifestyles. We love what we do, and when I'm not at work, I enjoy the wonderful outdoor lifestyle of the sunny coast, navigating bush tracks and climbing mountains. While we weren't able to get Andrew and Fred, our very special guests, up here to conquer any coastal climbs with us, they have made some time to share with us how they've navigated their very own tricky and at times steep tracks of markets and economies. The purpose for our session today is to give our clients and the members of QSuper over at SKU an opportunity to hear from the managers of the money, which, Fred and Andrew. I'll introduce them, and if it's okay, I'm going to read their bios because these guys have big and brilliant bios, and I want to make sure I get it right. Fred and Andrew will then take us through some slides they've prepared. They've got a lot of really great content to share, so that might move a little bit fast, but I promise that all this amazing detail will be recorded and uploaded for you to rewatch or share with your colleagues. We've got some time at the end of the broadcast for questions, but we do have a chat box. So if throughout the session you're wondering something, thinking a question, please pop it in the chat box and we'll circle back to it at the end. So by way of introduction, I'm going to read Andrew Peck's bio. So Andrew Peck is a portfolio manager at QSuper. Andrew joined QSuper in 2013 and he holds a dual role. He monitors and forecasts the economic and market outlook across Europe, the views of which guide relevant positioning across fixed interest and equities. He also manages and monitors whole of portfolio risk across several lenses, including through stress testing, back testing, internal models and process, and event risks and regulation. Andrew has also designed the strategy's fixed interest modelling and DAA framework, including a bespoke tool on assessing assets appeal. Andrew was formerly a senior economist at Queensland Treasury and a finance economist at Queensland Treasury Corp. He earned a master's degree in applied economics from Massey University, New Zealand, and is a CFA level 2 candidate. Joining Andrew is Fred Gibson, portfolio analyst at QSuper. So Fred joined QSuper in 2019 as part of the team that looks at currency and global macro. Fred integrates global economic forecasts with asset class valuations and positioning and has a particular focus on emerging markets. Fred spent 5 years as a senior economist at Export Finance Australia, where he provided country risk assessments and ratings, economic input into group strategy, and in-depth market briefings for clients, industry, and government on economic and geopolitical issues. Before this, Fred was lead analyst for New Zealand, Indonesia, and Thailand at Moody's Analytics, where he covered ASEAN and the Asia Pacific region and led stress testing and scenario analysis. He was also involved in forecasting and co-authored the Moody's stress test of the Australian housing market. Well, that would be a very interesting one. Fred holds both an honours and a master's degree in commerce economics from the University of Otago in New Zealand, as well as a master's of applied finance from Macquarie University. So I think, guys, welcome. Thanks for coming across the ditch and for also joining us today to share your valuable insights and knowledge on what you love and do at QSuper. So I'll hand over to the guys.
Yeah, no worries. You made us sound really, really good, so we'll try and keep up to the hype. I'm going to share the screen now. Yeah, great. So as the title indicates, look, we do see a lot of uncertainty when you look around the world. So for the first time in decades, inflation appears to be on the rise. Economic regimes look to be changing. Tensions with China and the West appear to be rising. And of course, those COVID uncertainties still linger around. So with that in mind, our focus here today is to demonstrate how we're managing these risks and your money as best as we can. So before you hear Fred speak on the interesting stuff toward the end, you're going to have to make do with hearing from me in the first half, starting with QSuper's recent performance. So here we have our suite of diversified investment options, or DIOs, up the top. So we have balanced, moderate, socially responsible, and aggressive. And below that we have the self-invest options: cash, diversified bonds, international shares, and Australian shares. So we also have the corresponding returns over the last decade, the last 5 years and 12 months. I'll show the lifetime cohorts very shortly on a separate page. So the good news is that all of these DIOs have hit a home run. They've achieved their CPI plus objectives in all of those columns. Moderate by only a whisker, so it's got 4.1% there over the last 5 years versus the necessary 5, versus the necessary 4, sorry. But all others really displaying strong returns well over their hurdles. Now, the market environment has generally favoured equity risk. After Lehman Brothers collapsed in September 2008, we entered this, this post-GFC sort of world where central banks have really bent the rulebook on how to stimulate economic activity. More recently, in the wake of COVID, governments have stimulated economic activity in very creative ways as well. And so all of this has really supported businesses, which has fed into higher corporate profits. And it's, of course, seeing equities rise. Now, it is true, had someone been invested in equities only, as you can see down the bottom there, returns would have been higher. That, of course, is with the benefit of hindsight, though, right? There have certainly been long periods as well, keep this in mind, throughout history where the shares have not been the star performer. So as a consequence of all of the stimulus from central banks and governments through the decade, official cash rates are basically around record lows. And hence, cash as an asset class has returned negative 10 basis points over the past year. Now, this is something we've communicated to all members several times over the last 12 months. This is more a macroeconomic story as opposed to a QSuper story. Might just touch on the socially responsible option there, or the SR option as we call it. So a couple of years ago, we conducted a very large survey. We asked members what they wanted to see in an SR option. So we responded mid last year by redesigning it and bringing it in-house. Previously, it was managed under AMP, and now it's managed under us. So some of the key benefits in doing so included, well, we figured out first of all that it was actually going to improve the likelihood of meeting the investment objective with less risk. So that was a great thing. Second, bringing it in-house actually halved the investment costs and fees for members like yourself. So that was another benefit. And third, it's seeking the investments that had a positive impact on the world as requested by yourself. So according to Super Ratings, the SR option was the fastest growing of its kind in Australia last financial year, up 174%. And as another positive indication, the members' average balances have risen by about 50% in that option. So that point brings me to another one. Look, you don't need to have all your money invested in just one of these options, of course. And also, please don't forget, we have 80 exchange-traded funds, or ETFs as they're called, under the Self-Invest platform. So they offer scope to gain exposure to listed property, Australian or international equities of different variations, commodities, infrastructure, you name it. So I recommend you take a look at that too. Just remember though, I can change a light bulb, but I'm definitely not an electrician. And more relevant to you guys, I can remove a splinter, but it doesn't make me a heart surgeon. Now we're going to go over to the default lifetime structure now. So here, your age and your account balance determines which of those 8 cohorts or those coloured areas you currently are in. So as your balance increases and time evolves, you end up heading toward that top right quadrant. This strategy is important to us. We're fond believers of it. And back in May 14, when it was launched, we were the first in Australia of its kind. So the whole intent is to shift your funds from focusing in on capital accumulation in the early years and toward capital preservation over time. And here, just so you know, the Outlook cohort, as well as Aspire 1, they are broadly equivalent to the aggressive option. So they are quite high risk. And of course, as mentioned, as you populate through all the other cohorts, you're de-risked just to save your money. And accordingly, you would expect higher returns in those high-risk cohorts relative to the sustained ones and the sustained twos, which are lower risk. We don't have the 10-year compound average there because it hasn't been in place. So I just want to take you through what the balanced option has looked like throughout the last decade. So here we're comparing that to the median peer fund, which by comparison is traditionally more heavily invested in equities. Get to a bit more detail on that soon. So over the long term, this strategy has provided a much smoother ride, and that's indicated by the volatility numbers. So 4.3, that's basically how many standard deviations. 4.3% is the standard deviation measure of how much those lines are sort of bouncing around. Because that's lower than the 5.7, then we can argue it's got much less volatility. It's also achieved higher returns versus the SR50 fund too, which is another benefit. I should mention aggressive, that has returned higher than balanced again by about 1.5% per annum over this same period. And it carries the same smooth ride philosophies of balanced, of course. So the technical term would be that they've got broadly matching sharp ratios there. And over the last few years, we've also won 5 few awards. I'll let you have a read of that at your leisure, and they're also on the website too. So it does pose the question, right? How is it that returns have been so smooth? Why have you done better than the average fund and not lose as much money? I think the key answer to this is that our return drivers are much more diversified across asset classes and geographies. And it's sort of indicated here where the diversified circle represents QSuper's balanced option. The traditional one there is the SR50 median balance option. Just a heads up, I'm probably going to go into a lot more detail from now on, but I hear it's being recorded. So you can, of course, rewind the tape to pick up anything you might have missed. So I've mentioned before, the traditional fund tends to have a lot more equity exposure than we ordinarily would, and that's highlighted in that dark blue bar, and the traditional fund being a lot larger. There's also a tendency for many other funds to bias their exposures toward Australia, despite Australian businesses representing only about 2% or less than 2% of the global market capitalisation. We are much less concentrated within Aussie equities, but equities more broadly. It's not that we hate them, it's that we like other asset classes a lot more at times. So we tend to hold a lot more unlisted relative to other funds. I'm sure you're aware your money's invested in airports such as Brisbane, Edinburgh and Heathrow. You're also invested in the Port of Brisbane, hold office towers in Texas, Chicago and New York. And I'm sure you're familiar with One Times Square, the building where the ball drops down New Year's Eve. You own a chunk of that too, and the advertising costs are insane. I suggest you have a Google to find out for yourself. That's, of course, a great income generator. Now, having said that, one of the key differentiators of our strategy versus many other funds over the past decade is our exposure to something that's called high duration bonds, which is this bar here. So what is that? Well, governments around the world issue debt. That might be issued from the Queensland government or Australia, could be the UK or could be the US or India, any government, right? You name it. Now, they borrow money, which is done by issuing bonds to investors. The yield on those bonds depends on a few things. It, of course, depends on the government's ability to repay it and their track record in doing so. It's going to depend on the economy's structure and the inflation credibility of the economy and all those kinds of things. So a typical fund in Australia tends to invest in the shorter dated debt. That might only be around 5 or 7 years maturity. So think about investing and getting all of your money back within 5 years. You're really only lending shorter term. So we tend to invest in the much longer dated stuff when the price is attractive, say up to 20 years or more. Now, there are a few reasons why we do this. Now, first, the returns have tended to be much higher here. So we're rewarded for lending to these governments at long maturity. Crucially, though, the price sensitivity is much higher the further out you go. So put another way, as interest rates fall by a little bit, rather than the price or the value of those going up just a touch, they go up a lot. So there's a lot more sensitivity to what interest rates do, which can be good and it can be bad, depending on what way interest rates go, of course. So that gives rise to a lot more volatility, but we would argue we're talking good volatility. And I'll get to the details of that in a minute because it has very good diversification properties. Onto the returns of this asset class first, though. Now, fixed interest is the same as fixed income. It's generally the same as bonds. It's all kind of the same. So some of you may have heard about the Your Future, Your Super performance test the government's now imposing on all super funds in the country. The financial year returns of that government benchmark for this particular asset class is shown in those blue bars there, those light blue hollows. And it's also shown here on a total returns basis if you were to invest $100 back in June 2010. And invest it. Now you can see clearly the benefits QSuper has delivered here. So for those of you in any of our diversified investment options, up to a quarter of your super balance has been invested in this asset class. So you can see on the right, rather than turning $100 into $175 over the last decade, we've turned it into about $275. So that's 11 years, not a decade. If you look on the left, some of those returns in this asset class have achieved north of 20% in 1 year. So this asset class returned 33% in the 2012 financial year, a cumulative of 36% over the 2 years ending mid-2020 for a Gibson lifetime. Those are big numbers, right? And they certainly rival equities in some points. And the good news is, though, that when equities do fall, this is when these bonds really work for us and take flight. They're among the most defensive asset classes there are. So this chart shows all the periods where equities have indeed fallen in the past decade. The technical term is a drawdown, which basically means, where the current index level is relative to its historical peak. Now, nearly every time, not all the time, but nearly every time when equities fall, bonds have been there to offset or hedge the fall, keeping your money safe, and of course the decline in the super balance much less. Now, the average of those red lines, so the average drawdown or major drawdown happens to be about minus 18%. The following scatter chart that I'm going to show you basically displays how all the various government bonds issued in the world historically performed on average through all of these equity falls. That's going to be the x-axis on this next chart. Now, what's going to be shown on the y-axis is just what the 10-year average return has been, regardless of what equity environment we've been in. So this is how it looked. Give you a bit of time to absorb that. So you can see obviously that you would want everything to be up in the top right quadrant. You want to hold all these bonds up here that were positive returners, 18, 20% odd, when equities fell, because of course, if you had $1 invested in bonds and $1 invested in equities, and equities fell 18%, if you held US bonds at the time, then that's going to fully offset that. So you want to be way up here. You don't want to be down here. So that's really good, right? Now, if you're wondering where the government benchmark was, where most other funds have invested over the past decade, it's somewhere between where Malaysia is and India. So well done to them. The key issue is that most of these bonds have lost their shine recently. So interest rates now are quite low, which begs the question, how low can they go? Most have lost some of their capacity to rally, and this is something we've been monitoring for many years now. But of course, we knew at the peak of the COVID crisis, when most developed market interest rates were at record lows, this was the time to sell. So this is essentially what's happened. All of those bonds looking forward rather than looking back. So the good news is, at the height of the COVID crisis, when it was time to sell, we could, because the board has offered us delegation to do so. They provide us with these ranges with which we can trade. So the fixed interest asset class can have a weight between 0 and 35%, and this is for the balanced option, and so on and so forth for all the other asset classes. So at the height of the COVID crisis, when equities fell 30%, we were, of course, buying up those cheap equities while simultaneously selling down, not all the way to 0, but towards 0. So with that, I think I'll hand the mic over to Fred.
All right. Well, thank you, Andrew. Always a very hard act to follow. So as Andrew mentioned, good afternoon, everyone. I'm Fred. I'll be taking you through the outlook in a post-COVID world, the implications for asset prices. It all starts with COVID. So the key message that I'd like you to take away from this slide is that, given the modeling that was done, the key insight here is that you get further COVID outbreaks, it's likely to delay the recovery and not derail the recovery. And I'll dig into why that is. So if we look at vaccination rates around the world, they have picked up. What we have observed is that countries with rather advanced levels of vaccination have been able to open up sooner. Their recoveries have been able to progress. And when there has been outbreaks, policymakers have had a preference for more targeted measures as opposed to the more broader-based draconian lockdowns that we experienced at the start of the pandemic. Here in Australia as well, we can see a similar narrative playing out. If you look at New South Wales and Victoria, the vaccination drives are a lot more advanced, and New South Wales in particular has been able to open up. So from an economic recovery standpoint, looking at it through that lens, the recovery should continue to progress. If there are further outbreaks, more likely to delay as opposed to delay. So that's a good news story from a demand perspective. And before I dive into this, recall that household saving ratios at the height of the pandemic last year was around 22%. Since then, they've come down to 10%. But to give that context, leading into COVID, household saving rates were around 5%. So there's a lot of money that households have saved that they're using to go out into the economy and spend, whether it be on goods and services, going out to cafes, bars, etc. And we expect that trend will accelerate within the next 12 to 18 months as we see the real view of lockdown. The other thing that's really interesting to note has been the government response with fiscal policy. Now, before I dive into this, I think it's important to take a step back. As Andrew mentioned, if you look at the last 30 years, every time there was an economic downturn or there was a negative shock to the economy, the playbook was the central banks would cut interest rates to try and decrease the cost of credit, make it cheaper, so that households and businesses go out and borrow to invest and to consume. That was indeed the case in the GFC, where we saw rates approach near 0. And we also saw central banks embark on really novel measures such as quantitative easing, unorthodox monetary policy. Now, a lot of this, cheap credit and the large supply of credit actually went into asset prices. So we got what we call asset price inflation. So it was great for the stock market. Bonds returned really well. Property did well. Consumer price inflation, however, didn't do so well. And it's no coincidence then that wage growth was also subdued. So if you look at the sort of dichotomy amongst households, you had the higher middle income earners who tend to hold more assets. They benefited quite strongly from this asset price inflation, whereas lower to middle income households, particularly low income households that are living paycheck to paycheck, they didn't quite see the strong wage growth that asset prices. And so what happened is you got this increasing divide, you see this widening inequality, and then you had COVID. And so when COVID hit, as Andrew mentioned, you saw some central banks around the world resorting to easy monetary policy, cutting interest rates, increasing unorthodox policy there. But you also saw this big ramp up in fiscal spending as well. Now, this is part of a secular trend that we expected would happen, and particularly as governments look to address that inequality. And the rationale being that if you put a dollar into lower to lower middle income households, they're more likely to go out and spend that dollar in the economy, which is great for demand. If you give that same dollar to, say, higher income households, they're likely to spend less of it. They're more likely to invest the same because they likely have everything they need for goods and services. So this push for more fiscal spending to help bridge that inequality gap, that's great for demand and great for economic growth moving forward. So just to recap, we've got strong household balance sheets. They're likely to spend that, which will support demand. We've also got this accommodative fiscal policy. On the other side of the equation, we've got supply side bottlenecks. Now, I'm sure many of you here on the call have had some experience of product delays, or you've gone to buy some household wares and been told, oh, you actually have to wait 6 months to so we've got this instance where we've got really strong demand, but we've also had supply constraints. So the supply hasn't been able to keep up with demand, and that's leading to elevated inflation. So a friend of mine noted the other day he went to trade in his mother's car with his mother's permission, of course, and he was quite surprised. It was a Mazda 3 that he had bought 5 years ago for $32,000, and they offered him $24,000 for it. And that's sort of a symptom of the sort of shortage of brand new vehicles out there. And so, not surprisingly, in the headline inflation numbers, you're seeing a tick up in inflation. Now, we've got Australia and the US in here, but you can pretty much put on any other country across the globe and you see a very similar narrative. Now, from a monetary policy perspective, policymakers at the start of the year were saying, oh, this is going to be transitory. Once the supply side bottlenecks ease off, we should see inflation fall back to lower levels. And indeed, we do expect that will be the case once some of these supply side measures ease. But I think what we also need to be cognizant of is, the demand. As I said, we're in this new secular regime where fiscal policy is likely to be a lot more accommodative as it tries to bridge this gap, this inequality gap. And so what this means is, we're likely to see inflation expectations start to trend higher. Now, that's when central banks really start to pay attention, when inflation expectations start to trend higher. So the chart here on the left, inflation expectations, is derived from the swaps market. So it's what the market uses to price inflation. So from this, we can sort of garner what the market is expecting in terms of inflation over the medium term, sort of beyond 5 years. And we can see that that's most definitely ticked up, particularly in the United States. The chart I really like, though, is the one on the right. So this is inflation searches on Google, right? So using Google Trends data, you can look at how popular inflation is. And no, it's not Pecky and I just, Andrew Peck and I just, ramming inflation searches on Google 10 times an hour. I'm sure there's a bit of that, but more broadly, what we've seen is that it's become increasingly more popular amongst the broader population. So, this 100 here suggests how popular it is on Google search. And so if you look at inflation, we can see it's definitely picked up over the last 12 months. And to put it in perspective, the last time inflation was such a hot topic per se was about 2007. That was when the first iPhone was released, so generation 1, and I think we're up to 15 now. So it's been a while between drinks, but what we are starting to see is these stronger inflation pressures start to build. Now, from a central bank perspective, when they see these inflation pressures start to tick up, they go, oh, it might be time to withdraw some of this extraordinary monetary stimulus that we've seen. And we've seen that with the Reserve Bank of New Zealand, close to they've raised rates, 25 basis points. We've seen the Federal Reserve, a much bigger central bank, start to telegraph, its withdrawal of monetary stimulus later on. So in this world where we've got, it's likely now that we will start to see less monetary stimulus. What does it mean for asset prices? So, touching on bonds, higher interest rates are not good for bonds. It usually means the value of bonds tend to fall as they sell off as interest rates rise. From an equity market perspective, well, if you think about how, one way to value equities, it's a series of cash flows of earnings. What does a company earn this year, next year, 5, 10 years into the future? And that's normally discounted by a discount rate, right? And that discount rate is effectively the interest rate plus a risk premium. So what happens is if you get higher interest rates, right, the value of those earnings, all else being equal, nothing else changes. The value of equities will be lower. But you got to take a step back and ask yourself, well, why are interest rates rising? And they're rising because we've got stronger growth outlook, stronger inflation outlook. And some of these companies, their earnings are actually, they benefit positively from this higher growth and inflation. So it helps provide a bit of that tailwind, even though there's a headwind coming from higher interest rates. So, there'll be sectors within the equity market that will actually do better than others. So, sort of cyclical and value stocks, they tend to do better in this environment, ditto. And then within unlisteds as well, you have some assets within the unlisted class, some of them, where some of their cash flows are actually indexed to growth and inflation. So again, they will get that positive edge from. So that's sort of a brief overview of what we've observed, and what we've tried to do here in strategies. Taking this narrative which we've held for a while, try to position the portfolio so that it's consistent with the other risks out there, and of course achieving the aims that Andy talked about a strong return, but also ensuring that we minimize the variability as well. So this is a quick summary of what we've done. I'll go into these in a little bit more detail. So first with the bonds. So as Andrew mentioned earlier, when COVID hit, and even before then, we saw bonds rally strongly, particularly through COVID. That was great for our members. They saw a healthy return from fixed interest. But then after the COVID event, we did see that the ability of bonds to provide a return and to hedge some of those events in the future have been impaired, and so we sold. Right? What also has happened in that time is if you look at emerging markets. So emerging market bonds, they do offer a more attractive return compared to their developed market counterparts for the reasons I mentioned earlier. Recognizing, of course, there are risks with investing in emerging markets, but taking into account those risks versus some of these higher yields, some of these markets have looked very attractive, and we have taken small exposures there. So we've got some exposures in emerging market bonds because I think an interesting point to note, Andrew, I'm sure you have a view on this as well. We've seen yields start to sell off a little bit in developed markets, as I said, related to the expectation that the recovery is. So in time, as that happens, the ability then to hopefully diversify in the future also improves.
Yeah, exactly. So you can see bond yields fell, below 1% there, just above the 9 on the COVID-19. So that's when we were selling them. But of course, much like when equities cheapened 30%, you can see those yields back up or rose. And as yields rise, the price on those bonds falls. So of course they are cheaper, and therefore we've been buying a little bit, not significant amount, but buying a little bit as they've cheapened over the past year.
The other thing I'd like to bring attention to is unlisted assets. So we've had these is just a flavor of some of the exposures we've taken on over the last 12 months, and I'm just going to pull out a couple on the page here. So MAP Energy, it's a renewable energy and storage facility in the US. It's got about 16,000 megawatts of energy generated from both wind and solar, and that's got strong return outlook for our members. So that's really good. The other is Mercury Trust Distribution Centers, cold storage and logistics. So, one of the things that we saw during COVID was more and more people were shopping online, ordering goods and services, getting it delivered to their houses. So, to do that, you need large logistics centers, cold storage, etc. So, to help get us exposure to that thematic, long-term thematic, we've got exposure there, which will be of benefit ultimately to our members. The other thing I'll touch on quickly is our equities portfolio. So, the QSuper balanced equities portfolio. We take a lot of the same sort of thematics that we use to construct the broader portfolio about having a diversified source of returns, having a differentiated driver. So if you look at how the QSuper balanced equities portfolio compares to a 60-40, by that I mean 60% with the ASX 200, 40% international. From a returns perspective, they're very similar. But where they are a little different is if you look at the volatility, the variability you're likely to experience. The QSuper balanced equity portfolio has lower volatility, particularly during those stress periods. One of the other things is, as I said, we like to invest in a broad range. We've got exposure to faster growing emerging markets as well, because that will help provide a driver of returns and growth into the future. We see it in countries like China, which is already the growth engine, but their population is also becoming increasingly wealthy. So, we see opportunities there. The other thing I touch on here quickly is commodity prices and inflation. As I said, during the macro update, inflation pressures are building. One of the things that we've done is we've got exposure to commodities within our portfolio, and that helps hedge inflation risk. Now, why is that? Because often higher commodity prices get passed on to producer costs. Producer costs then therefore get passed on to consumer prices. So if we've got commodity prices in the portfolio, it does hedge some of that risk. The other one here is foreign currency. So I'll just take a step back for a minute and explain how this works before I delve into this chart. So with foreign currency, let's take the Australian dollar. The Australian dollar tends to be positively correlated, or it moves with global risk assets like equity. So when equity markets go up, we tend to see the Aussie dollar appreciate against particularly safe haven currencies, which are the US dollar, the Japanese yen, and the Swiss franc. Similarly, when you see negative equity events, that tends to weaken the Australian dollar, tends to depreciate against these haven assets. So having some of this in the portfolio actually helps protect against some of these equity and bond sell-offs. So as way of an illustration, let's just say that you've got $100 US, and just hypothetically, the exchange rate with the Aussie dollar at the moment is 1-for-1. So you've got 100 Australian dollars. Now let's say there's a negative equity event, and that causes the Australian dollar to depreciate by 50%. So now $1 buys 2 Australian dollars. So what happens then is that your $100 in the US is now worth $200 here in Australia. So that's sort of an example of how having exposure to those safe haven currencies can help hedge some of that equity risk. And here the chart, we've seen it happen through COVID-19, and also with bond sell-offs during July in 2018 and earlier this year, where we saw bond yields rise and sell-off. Foreign currency was able to give us some of it. So quickly, just before we get into Q&A, just sort of wrapping up here. The aim here is to ensure that the portfolio generates returns, and returns have definitely been good, particularly compared to the peer funds, but at the same time ensuring that volatility or variability is contained. And the key driver there is having a diversified portfolio of assets where we can access different streams of return.
There's certainly a lot of detail exercising your mind, guys. So thank you for the opportunity to hear some of those stories, and I think it's particularly interesting. Some of the alternative assets or the unlisted assets that you get involved in. I think those stories, are very interesting and super unique to QSuper. So question time. So if anyone online on the call would like to ask a question, by all means, type into the chat box. But, I've got some questions that we collected earlier. And if I could ask, guys, it's been in the news. We've heard QSuper and Sunsuper plan on merging your funds shortly, and I wonder what does that mean for QSuper members?
Yeah, it's a good one. Look, I think in short, it means you'll soon get the best of both worlds. So Sunsuper's Ian Patrick will be the CIO under the new organisation. Our current CIO, Charles Woodhouse, will be the deputy CIO. They're working very well together currently. So importantly, between Sunsuper and QSuper, we've obviously both got very good track records, and importantly, the investment philosophies are very much aligned. So there's no major conflicts there, which is a positive. I think, so in short, you're essentially going to see a lot of positive change over the coming year or two as a result of this all, where the best minds of both organisations battle out to figure out what's best for the broader membership.
Yeah. I think, just adding to that, Andrew, will be a much bigger fund as well. So the opportunities that open up for our members, for both sets of memberships, is really exciting, and should definitely bring benefits to the members over the horizon.
Yeah, good, excellent. We've also heard in the news a lot of angst over China and property development and Evergrande. So, what do you guys, what's your view, or how do you think this sort of emerging issue in China is going to affect markets? Should we be worried?
Sure. Thank you for that, Joanne. Yeah, so it's a risk we're definitely watching, the Evergrande risk, but the sort of research and analysis we've done at the moment suggests that at this stage, the sort of worst case scenario we can see is a replay of 2015, where China had a bit of a soft landing, not a hard landing. And so, if we think about the implications there, it could be softer for, sort of bulk commodity prices, etc. Global growth could also be a bit softer on the back of that. In terms of, how we could cope with the portfolio, as I said, we've got that safe haven currency in there with the US dollar, so that could see some upside from this. Is also in this environment with the slowing China, particularly if it was to play out with the worst case. We could see central banks start to ease off some of that interest rate hiking as well, which would be great for bond valuations, which again, we hold in the portfolio. So it is a risk that we're watching, and it is something we continue to monitor, but we believe we've got having the benefit of having that really diversified portfolio across various streams of and sources of return will help the portfolio navigate those.
Good. So the sky's not falling in.
Yeah. No.
No. So a concept that you guys mentioned, spoke about in your presentation was the government's performance test. And this is quite an interesting one. So I wonder, how do you feel that will have an impact on the fund?
It's an interesting one. It's certainly having an impact on the industry. So as background there, so the government together with APRA, they're going to be benchmarking currently the MySuper options, but next year a broader assortment of the options such as balanced, progressive and so on a rolling 8-year period. So essentially, should the fund's performance be worse than minus 50 basis points per annum versus their customized benchmark, you're going to be legislated to write all members a letter. And should you fail the test the following year, the same thing will happen, but you're also going to not be allowed to have new members into the fund. So it is a significant piece of legislation. What's encouraging from our perspective, I suppose, is last year's estimates by APRA that were not legislated at the time. So last year's estimates, they highlighted QSuper's lifetime products did exceptionally well compared to the test. So from memory, Outlook was outperforming by about 1.6% per annum. So it's positive versus the negative 50. So that's a great starting point for us. So it should not require significant changes for our fund. We, like other funds, of course, are taking the test quite seriously. We're monitoring the performance of the test internally, of course, as well.
We've had a question from the call. You guys mentioned monetary and fiscal stimulus. At some point, will this debt rack up to the point where citizens and taxpayers cop the bill and thus overall economic activity slows down considerably?
Yeah, no, that's a great question. That's a great question. And yeah, so I think it's important to take a step back here and sort of, what fiscal spending is hoping to achieve as well is to drive stronger growth outcomes, right? As I said, if you look back between the, post GFC to pre-COVID, a lot of that monetary stimulus wasn't ending up in the real economy. So the hope here is that fiscal spending, yes, it's going to be elevated, but it also helps drive, stronger consumption and investment outcomes from the private sector. So, the way to visualize it is the government spending at the moment, it's getting the economy back up on its feet, it's hopefully driving and delivering better growth outcomes, stronger wages growth. The private sector can then take that baton and run with it, and that growth cycle becomes more self-sustaining. And then, of course, once the private sector comes to the party with stronger growth and investment outcomes, governments can look at reining in those deficits and starting to pay down that debt. So that's the sort of the upside scenario that we're seeing. That's the best case scenario that would play out. Yeah. On the other hand, we've seen historically for governments that just go on printing without any care in the world, what tends to happen is in time you get very, very strong inflation outcomes. You get a weaker currency, and of course, then investors require a higher risk premium to invest in the assets in those countries. So, there will be some discipline imposed by the markets. But, policymakers at this stage are definitely taking the optimistic view that they'll get growth revived and going again, and then the private sector can take on the baton from there, and then governments can pay down that.
Thanks, Fred. Look, I think we've gone a few minutes over time. So what I'd like to say is, any more questions that you may have, by all means, please, pop them through and we'll come back to you. It is a live broadcast. We will upload it so you can re-watch it. And thank you, Andrew and Fred, for sharing your time and your valuable insights. I think having access to your amazing minds and your methodology on how you manage, your clients, your members, retirement nest eggs is an absolute privilege. And what I would say to the callers who've dialed into our webinar is, now that you've heard firsthand from the guys that manage the money, we'd like you to close with sort of our top 5 questions that we think we should be asking yourself about super. And those questions are, is your super going to be enough? Should I be splitting my super? Am I in the right investment option? Now, we've heard some great information from the guys today around QSuper and how they manage the money for amazing outcomes, but which is the right one for you? Could I use my super to help pay for my personal insurances? And finally, what happens to your super if something happens to you? So answers to these questions, you can find by having a chat with us or by downloading. We have a superannuation working paper that we'll make available via a link that we'll attach to the broadcast recording. I think it's very clear that Andrew and Fred have great enthusiasm and passion for what they do, and that's managing, your money. We love also the work that we do, and we look forward to continuing to be your support and the gateway to, your very richest retirement outcome. So thank you guys for joining, and look forward to chatting again soon.
Yeah, no problem. Thanks for the opportunity. It's been good.
You.